I'm here teaching Building a More Profitable Business series, and today we'll be talking a little bit about understanding your financials. This is presented by myself, Jeremy Lott, with Foundation Accounting and Consulting, and by the Salt Lake HBA. So first I want to tell you a little bit about myself. I started off in the landscape industry and had a business for 15 years doing landscape design and then managing installs, and loved it. It was fantastic. And I loved doing what I was doing, but I didn't understand my financials. I was constantly frustrated by my cash flow and what was going on with my money. And so eventually I ended up in bankruptcy because I didn't know what was going on with my money. And I remember I went in a couple months after declaring bankruptcy to meet with my lawyer, my tax accountant actually, and my tax accountant said to me, "Yeah, I saw that coming from a long way off." And I was so frustrated, I couldn't believe it. Here was my trusted advisor that I was relying on to help me out with my finances and understanding what was going on with my money. And he had let me down completely. And he knew it was happening and he hadn't said a word. So it was right then that I decided to become a trusted advisor for the construction industry by becoming an accountant and helping my fellow contractors be able to understand their finances and what's going on and be able to stay on top of their money. And so that's a little bit about how I got into the industry. So accountants are kind of a rare breed of people, and we tend to have our own language. And part of the reason for that is the stock market crash of 1929. So this was the very start of the Great Depression, and what happened was there were people that were investing in companies that they just didn't really know at all how the companies were doing, because there was no way to compare one company with another. When one company says revenue, well, what does that mean? Another company has their sales and we don't know if it's the same thing as this other company, and so on and so forth. And so we ended up developing a language of our own at that point in time that we could use across the board to be able to understand our finances and what's going on with any company whose financial statements you pull up. And so that all came about from the Securities and Exchange Committee, and that's how we ended up with our standard financials that we have today. There's a little cartoon about the stock market. So today there are four basic financial statements. And these are the four basic financial statements that we use to understand what's going on in a company. And this is why financials are so confusing, because accountants got involved and they came up with this language, this standard language for everybody to be able to understand what they mean when they say revenue or when they say cost of goods sold, or some of these different terms that you may have heard before. And so they also developed these four basic financial statements to be able to compare one company to another. So the four basic financial statements are the balance sheet, the profit and loss or income statement, the cash flow statement, and the statement of equity. Now, we're not going to talk much about this statement of equity. It is very important for investors, but when it comes to running your business, there's not as much information in that we can glean. Useful information to help us make business decisions as there are in the other three statements. So we're going to focus on those other three statements today. Okay? So let's talk for a second. And we're going to talk about a little story about Bob the Beaver. He's the broke owner of a business. That's what Bob stands for. A broke owner of a business. And that's what I was when I had my landscape company. I was a broke owner of a business. Yes, I would have cash in the bank at sometimes, but I was still broke because I didn't know what was going on, and I was in a worse position than I knew I was. So we're going to talk about Bob, and we're going to talk about Bob's old beat up truck. And we're going to compare that to a new truck. So we're going to compare those two, and we're going to use that analogy to help us understand the financial statements, the different elements of the financial statements, what goes into them, and what they mean and what they're used for. Okay? So we're going to start with the balance sheet, and the balance sheet has three main components: the assets, the liabilities, and the equity. Those are the three sections on a balance sheet statement. Okay? So on a vehicle, we can compare the assets to the exterior or the foundation of the vehicle. So if we're looking at Bob's truck and we're comparing it to, say, a new truck, what kind of outside do the two have? Well, they're both going to have a pretty sturdy chassis. They might have a little bit of a lift, depending on what all they use it for, if it's for towing or things like that. They'll both have a little bit more hefty transmission. They'll both have a bed, so they can put things into the truck in the back and be able to haul. And all of these things fit together to help us define what kind of work the vehicle can do. So if you have all these different things together for a truck, we know we can haul with it. We know that we can load things up in the bed. If we have an extended cab, we know we can haul people with it too, right? So all of these different things contribute to what the vehicle does and what it's used for, what its overall purpose is for. So assets are the same way. Assets are what your company owns. They're used to make money by producing products and services. So the different assets your company has, your equipment, your tools, your vehicles, all of these things, they're used to make you money. And that's kind of a rough definition of an asset. Something that is used to make you money. Okay? So again, like we said, the assets of the company help to define what kind of products and services are produced by the company. So if we're looking at a company that has a lot of excavation equipment and a lot of big trucks, dump trucks and other vehicles like that, they're probably going to be doing a lot of excavation or foundations or things like that, compared to a company that was loaded with, say, sprinkler parts and had racks for pipe and things like that. That would probably be a vehicle that would be used more for irrigation install in the landscape world. And so that's kind of the difference there, is all these different assets that we have help to define what kind of company it is that the business has, that the business uses, that the business does. Okay? And so assets include things like cash, vehicles, equipment, your inventory also, but also accounts receivable. Our accounts receivable is a promise to pay. So you do work for somebody, and then you invoice them, and then they promise to pay you, but they haven't yet. You haven't received that cash yet. That's what an accounts receivable is. It's a promise from your customers to pay you. Okay? And that is also an asset account. So, if Bob's truck were his business, what would we know about his assets? So if we're looking at his old beat up truck and we're wanting to know what kind of company that would represent, well, clearly they have a lot of older, more beat up equipment. They are still doing something probably in the construction world because it is a truck, it can still haul. They probably are struggling a little bit financially and don't have as much cash. They probably have a really high accounts receivable because they have a lot of people that owe them money, but not a lot of cash. And so these are some of the things that we can understand by looking at the assets of a company. How about the new truck? So with a new truck, it's newer equipment, it's more top of the line, but it's still a truck, so it's probably doing the same kind of work as Bob's truck, but it won't be as new or as efficient at operating as the new truck would be, right? So if your financials were a vehicle, your assets were a vehicle, what kind of vehicle would your vehicle be? That's something to think about. How would your assets look if they were represented by a vehicle? Yeah. So if we go back to our vehicle analogy, we can compare the second item, the liabilities, to the internal features of the car and external features, but the features of the car. Okay? These features make a vehicle more comfortable and nicer to ride in, but they're not necessary. You don't have to have power windows in order to be able to drive a vehicle or be able to haul things. You don't have to have heated seats. You don't have to have air conditioning. You don't have to have cruise control. All of these different features of a vehicle are things that go into the vehicle to help make the ride more comfortable, the journey more comfortable, but they're not necessary in order for the business to operate. Okay? So some of these things, as we talked about, keyless entry, the heated seats, power windows, the GPS or navigation system that vehicles have now, the backup cameras, all of these different things are features on a vehicle. So now let's take a look at the liabilities and the features of a company. So liabilities are what the business owes. So this is when the business owes something to somebody else. Okay? It's not necessary to have things that you owe for your business to operate. You don't have to have debt in order to operate. You don't have to have liabilities. You can pay cash for everything. But it makes it a little more comfortable, a little bit easier to operate if you do have a decent amount of debt. Okay? And we'll talk about debt and good debt versus bad debt and some other details as we get into the later versions or the later webinars in this series. Okay? Well, liabilities include things like credit cards, like bank loans, customer deposits, and accounts payable. So I want to talk a little bit about customer deposits. When you receive money from a customer at the start of a job, you haven't earned that money yet, because you haven't done anything. That means that if that person somehow was contractually able to back out before you started the job, you would still owe money to them because you haven't earned it yet. You have to buy the materials, you have to put in the labor, you have to put something together for them before they owe you money. And so a customer deposit is when you receive money up front for a job for work that you haven't done yet. Okay, so that sits as a liability. And again, you don't have to collect customer deposits. You don't have to, but it does make it more comfortable. It makes things a lot easier to operate if you have those customer deposits. Okay? And then accounts payable. So a lot of you probably have accounts at different locations. You can go purchase your equipment, or you can go purchase your materials for different jobs on an account. They charge it to your account and you promise to pay later. So this is what accounts receivable is. It's a promise from you to pay somebody else later on. Okay? So that's accounts payable. So if you were to guess about the features in Bob's vehicle, what would you guess were the features in Bob's vehicle? My guess is that he probably has a whole lot of features in his vehicle. He probably has power windows, he probably has keyless entry, he might have heated seats, he might have the GPS and the backup camera and all of these kind of features within his vehicle. Why? Because we know that Bob is a struggling business owner, and we know that he really likes a fancy vehicle. So he probably has more debt and more features in his vehicle than he needs. Okay? So it's a little bit about Bob's vehicle. So how about the new truck? Well, the new truck probably has a lot of features as well. Because when you buy a new truck, you want top of the line, right? So you're going to get all the fancy stuff in it. But the outside of the truck and the engine of the truck, which we'll talk about in a second, match the features. And that's why we would all prefer the new truck over the old truck. Okay? So, if your financials were a vehicle, what kind of features would it have? What I'm really asking with that question is, what kind of debts do you have within your company? Do you have a lot of debt? Or do you try to keep it as debt-free as possible? If it's as debt-free as possible, that means you don't have as many features in your vehicle. But if you are comfortable, then that means you probably have a good number of features within your vehicle, which would include having accounts payable and receiving customer deposits, and maybe there's a small business loan, things like that. Okay. So here's an important question. Why is it important to match the features in a vehicle with the outside of the vehicle? What importance would that have in your business? Well, as we talked about Bob's truck, his old beat up truck, he probably has a ton of features, but then the outside's kind of crummy. Nobody really wants to ride in the crummy looking vehicle, even though it has lots of features. Right? Everybody wants to ride in the nice new looking vehicle with all the features. So it's the same thing with the business. Do you really want to ride in a company that has a lot of debt, and not as many assets? That's kind of the question we're asking there. Okay. So let's take a look at the equity on a balance sheet. Now, I remember when I had my landscape company, I went in to get a loan from the bank. And the bank said, okay, well, we need a balance sheet from you. They referred to it as personal value statement, right? And I looked down their sheet and I saw assets and I thought, okay, I think that's kind of what I own. And then I saw liabilities and I thought, okay, I think that's kind of what I owe. And then I saw equity and I was just totally confused. I had no idea what equity is. But equity is important to understand because equity can be compared to the engine of the vehicle. So the whole vehicle is built around an engine, right? If you're going to build a truck, you don't want to put a teeny little engine in it. If you're going to build something more economical, you don't want to put a great big huge engine in it. So the engine needs to match the vehicle. And the whole vehicle is built around that engine. So without a solid engine, the exterior and all the features don't really matter. If you have no engine in your vehicle, it doesn't matter how nice it looks or what kind of features you have, you're not going anywhere. The vehicle will not serve its purpose. Okay, since the primary function of the vehicle is to go from point A to point B, you must have a healthy engine that fits the overall purpose of the vehicle. Okay? So we understand the importance of an engine to a vehicle. The equity is like the engine. So there's an equation that we use for the balance sheet. It's why it's called the balance sheet, because it's in balance. And it's assets minus liabilities equals equity. So you take everything that you own and you subtract everything that you owe, and what's left over is the equity. And that equity is the engine of the vehicle. It is the value of the company to the business owners. So if you are an S Corp, or if you are a C corporation, the people that own the company are the shareholders. You buy shares, they have common stock, and the people that own the stock own the company. And what they're really owning, the real value to those owners is the equity of the company. The assets minus the liabilities. Okay, that's what the value of the company is. And that's why it's important to have the equity section, so that the owners of the business know what the value is to them. Now, if you are an LLC, then the owners of the company are the members of the company, and it's owned according to the percentages that the different people own of the company, the different members. And if you're a sole proprietor or a partnership, for a sole proprietor, it is the business owner that owns everything. For a partnership, it's the partners, and that is split up according to whatever percentage the partners agree on in their organization documents. Okay? So that's what we're looking at. So equity is what the owners of the business own, or the value of the business. We've already talked about that. This includes some of the different accounts in equity include retained earnings, which means each year at the end of the year you have a profit or a loss. that profit or loss goes into a bucket called retained earnings. Then next year, we're going to take the next profit or loss and throw that into the same bucket of retained earnings. So if we have profits over the years, they will build up and keep increasing. And the retained earnings will get higher and higher and higher. But if we have a loss in there, instead of increasing, the retained earnings will come back down. They'll decrease by how much ever the loss is. Okay? We also have amounts contributed to the company by the owners. So you start up a brand new company and you own a truck, but the company can't afford to buy a new truck that's just for the company. So what do? You take your truck and you contribute it to the company. Well, you get credit for that. And that goes in the equity section, because that's part of the value of the company to you, because you've contributed something. So it doesn't just go into a black hole. It actually gets recorded and it gets managed in the owner's equity or the member's equity or the shareholder contributions. Okay, depending on how your company is organized and what kind of entity your company is. We also have in there amounts received by the owners from the company. So this can be loans to shareholders, it can be loans to members, it can be loans to owners, or it can also be dividends if you're a corporation. Okay, all of these amounts are recorded within the company so that we know how much value of the company has been paid out already. So if the company's worth $100,000, but we have paid out $20,000 in dividends, then that's going to lower the value of the company to $80,000, but we keep that $20,000 on there so that we know that the total value of the company is $100,000. Okay? So that's equity. And equity is probably the most difficult concept to understand. So if you understood that, you're in a good place. Just getting my timer back up here. Make sure that I'm keeping on time. Okay. So what kind of engine would you guess Bob has in his vehicle? If I were guessing, I would guess it's probably a little bit beat up. A little downtrodden. Bob probably has beat his engine up over the years and probably hasn't really kept up on the maintenance and is probably really struggling to get from place to place in an efficient way or quickly, because he's constantly having to repair the engine, right? Now, if we were looking at a new truck, I certainly hope the engine works really well. I certainly hope that the value is high for the equity of that brand new company or that healthy company, right? Which is what the new truck represents, a healthy company. So if your financials were a vehicle, what kind of engine would you have in your vehicle? So think about that. If you were looking at your total assets, you added all those up and you subtracted all of your liabilities, what would be left over? Would it be a healthy amount or would it be a small amount? Would you be struggling like Bob is? It's a very important question to think about. Okay? So, we need a way to track our engine. We want to be able to know what the performance is of our equity, right? And so we have to have a way to track how well the vehicle goes from point A to point B. That way we can understand better how the engine is working, right? If you have the bed of a truck, then you know it can haul stuff. If you have the right lift kit and you have the right transmission, we know it can haul stuff. But getting from point A to point B, actually getting there, we have to have a way to track that equity so that we know how well we're doing going from point A to point B. So some of the different questions we ask as accountants is, how fast are we getting there? And is there a more efficient way to get there from point A to point B? Also, what is keeping us from getting from point A to point B? Okay. So these are all questions that we ask about the equity of a company, about the engine of a company. So, most of you are probably familiar with the profit and loss of a vehicle. This is the way that we track all those questions we just asked about the equity. Remember how we talked about the end of the year, if there's a profit or there's a loss, it rolls up into the equity. So the profit and loss is a way that we track how well that engine is functioning and what needs to be done in order to make it more efficient or to be able to move faster to get from point A to point B. Okay. And we're going to use several gauges in order to track that. We have the speedometer, we have RPMs, we have the gas gauge, we have all these kind of things that we're going to use to track getting from point A to point B. Okay? So if the balance sheet, we're looking at the parts of the vehicle. It doesn't matter if it's moving or standing still. So when we're talking about the outside, the exterior of the vehicle, we can talk about the body of the truck. We can talk about the bed of the truck. We can talk about the transmission or the chassis. Any of these kind of things. Whether it's moving or standing still, it's still the exact same. Right? Same with the features. The features of the vehicle are the exact same, whether the car is moving or standing still. The engine of the vehicle, it's still the same engine, whether it's moving or standing still. Right? So with the balance sheet, we're looking at one specific point in time, and it doesn't matter if the car is moving or not. We're taking a look at it here, or here, or here, and we're figuring out the assets, liabilities, and equity at those specific points. So when you see a balance sheet, underneath the title balance sheet, it's going to say as of and a date. And that just means that's the date that we opened up our books and we took a look at the assets, liabilities, and equity. Okay? With the profit and loss, it's a little bit different because we're measuring and tracking that engine as it goes from point A to point B. And so we need to have a period of time that we're looking at a profit and loss, because we have to look at its travel during that period of time. Okay? So if you look under the title of profit and loss on a profit and loss, it's going to have from and a beginning date to an end date, because we're going to look at that over a period of time. Because in order for us to be able to track the performance of the engine, it has to move. It has to go from a point A to a point B. Okay? So it's a little bit of a way to hopefully understand the difference between looking at a balance sheet and a profit and loss. A balance sheet is just one point in time. We're stopping. We're going to take a look at the vehicle and take an accounting of everything that the vehicle has. Whereas with a profit and loss, we're measuring it from point A to point B. We're going to use different gauges and things like that in order to be able to know what happened with that vehicle during a period of time. Okay? All right, so the profit and loss, as I said, measured over a period of time. There's three main things measured on a profit and loss. First thing is the acceleration. The second thing is the braking. And the third thing is the RPMs of the engine. Okay, these are three things that we're measuring with the profit and loss. Okay, and we'll talk about all three of those. So, acceleration, the sales of the company, the revenue of the company. This is the gas pedal. This is how much you're pushing on that gas pedal, how fast it's going, how often you're pushing on it. That's the sales of the company. That's the revenue of the company. If you're having a lot of sales, you're pushing more on the gas pedal. If your sales aren't quite as high, you're not pushing quite as much on the gas pedal. Okay? It's really simple to understand there. Without sales, the car goes nowhere. So you could have a whole lot of expenses, but if you don't have any sales, the car cannot go from point A to point B. Okay? All right, braking. The braking is the expenses. And the expenses slow down your progress from point A to point B. So we have our sales, that's the gas pedal, pushing, going fast, taking off. And then we have the braking, which is our expenses. Slows the vehicle down a little bit. Okay? It's necessary to have some expenses. So you got to brake some when you're driving, right? If you didn't brake some, we'd all get in trouble. There'd be accidents all over the place, and we would get in trouble with the law, all kinds of things. And so you gotta have braking. All right. Your profit, or the time it takes to get from point A to point B, is the sum of the acceleration minus the braking, which is just common sense, right? But also with the profit and loss, your time that it takes to get from point A to point B is how much you're accelerating minus how much you're braking. Okay? And that's what we know as profit. We call that profit. Sales minus expenses is profit. Okay? So, as we mentioned earlier, if at the end of the year you have a profit, it increases your equity because it increases the retained earnings. If you have a loss, it decreases your equity because it decreases your retained earnings. I think we covered that enough earlier. So that's just another quick sneak peek of how that all works. Okay? So, next we're going to take a look at a special kind of expense that we call cost of goods sold. Okay? So cost of goods sold is an expense, but it's a special kind of expense, because cost of goods sold are the materials and labor and overhead, all of these kind of things that go into producing a job. So you have your selling, general, and admin expenses, which is the office manager that you pay. It is the rent for the building that you're in. It is your internet service, all of these kind of things go into maintaining a company, keeps a company up and running. But then you have the direct labor, the direct materials, and the overhead that all goes into building things, making products, right? Building the house, finishing the basement, doing the roof, doing the plumbing, all those kind of things. There are materials and labor, and then also what we call overhead going into producing those goods and services. Okay? So the things that go into producing the goods and services we call cost of goods sold. All right? So we compare this with the RPMs of the vehicle. You know that little thing that you're supposed to keep out of the red, right? That little needle you keep out of the red when you're driving. It used to be when you had a stick shift that you would know when to shift because the RPMs would get to a certain height and then you'd shift and the RPMs would lower. Anyway, the RPMs can go up and down with the acceleration. So if we're accelerating a lot, if we're selling a lot, our RPMs are going to go up as well. It's the same thing with cost of goods sold. If we are selling a lot, then the cost of goods sold will go up with the sales. So those two things tend to move together, and that's why we compare it with the RPMs of a vehicle. Because when you accelerate, when you sell more, you're going to have a proportionately higher amount of cost of goods sold. And we usually consider cost of goods sold to be a percentage of sales. So for instance, you may have a company that is operating at a 50% gross margin, or gross profit, which you may have heard before. And that is just the sales minus the cost of goods sold. So if you have a 50% margin, that means that about 50% of every sale is going into the materials and the labor and the overhead that is required to produce that sale. Okay? If you have an 80% rate, then that means that 80% of all of your sales, 80% of every dollar, or 80 cents of every dollar, is going toward the materials and the labor in order to produce those goods and services that you produce. Okay? So obviously, the lower we can keep the RPMs, the more efficiently the car runs, the less gas it uses. And we're going to talk about how gas is cash of the company in a minute. But you want to keep the RPMs as efficient as possible, which means you want to keep that margin as low as possible. You want to be operating at 50% as opposed to 80%. Because that means that there's 50 cents of every dollar left over after you produce the goods and services, as opposed to only 20 cents of the dollar left over after you produce those goods and services. Okay? All right. So we talked a little bit about the costs being related. The cost of goods sold are related to the sales. The higher the sales, the higher the cost of goods sold. Your selling, general, and admin expenses, your rent is not going to go up because you sell more. Your internet is not going to go up because you sell more. So all of these different things compare with the acceleration or the revenue of the company. Okay? So if you were to guess, how much would you say Bob is braking compared to his acceleration when he drives? I'm going to guess that he probably doesn't accelerate quite as much, and he probably brakes a little bit more because he's not going to get from point A to point B quite as quickly, right? So in a new vehicle, though, how would that compare? Well, if you're in a new vehicle, you can probably get from point A to point B a little more efficiently. You can probably accelerate a little bit more. The RPMs can probably go a little bit higher. So it gives you a little bit more flexibility when you're going from point A to point B. Okay. So how close to the red would you guess that Bob usually keeps his RPMs? Again, an older vehicle, a little less efficient, probably going to get up close to the red a lot more than with a new vehicle that's a little more efficient. So what would you guess is the profit of Bob's company? If he's not accelerating quite as much, if his RPMs go really high, and if he has to brake a lot, his profit's probably not quite as high. So as we travel from point A to point B, we're going to use gas. And the gas of the vehicle, the gas that we use is the cash. Okay? So the more efficient, or lower the RPMs, our path, and the less braking we have to do, the less gas we use. So if you're operating more efficiently, so you're at 50% rather than 80%, then you're going to use less cash or less gas as you go from point A to point B. Okay? And this is how we describe the statement of cash flows. The statement of cash flows tells us how much cash we're using and where we're using that cash. Right? So additionally, we use less gas when there's more expensive and efficient engine. So if you put a little bit more money into the engine, into the equity, then you can operate a little bit more efficiently. When the chassis and body of the vehicle are more aerodynamic, and when the features of the vehicle contribute to efficiency. So, you know the little green leaf thing that pops up in some of those hybrid vehicles that tells you that you're traveling green? That means that you're using less gas, right? So that's a feature on a vehicle that would tell you when you're using less gas. And there are different features you can get, like a line of credit, that helps you to be able to use less cash in your business as you operate. So a line of credit would be a feature or a liability of your company, and that would contribute to using less cash in your operations. If you run out of cash, your business goes nowhere. Just like if you run out of gas, your business goes nowhere. You gotta have cash. If you can't pay your collectors, and you can't pay yourself, and you can't pay your employees, you can't pay for materials, you can't function. You can't operate as a business. All right? We talked about the profit and loss and how it contributes a little bit to the cash and how that's used. The braking, the accelerating, the RPMs, these all contribute to the cash. There are some balance sheet items that also contribute to the cash. Accounts receivable. When you pay your accounts receivable, or when you are paid for your accounts receivable by your customers, then you receive more cash into your business, right? That's more cash in the tank. When you pay your accounts payable, this money that you promise to pay to other people, that decreases the cash in your tank, right? So the cash flow statement tells us how much cash is available in the business at any point in time, as well as where the gas went. much like a gas gauge, can tell us how much gas we have left in our vehicle and where the gas was used. Okay. So how much gas would you guess Bob uses? Probably uses a lot of gas, probably a gas guzzler. So he probably doesn't have much cash in his tank. He has to keep trying to replenish it all the time, has to refill it all the time. What things can a new truck have that makes it more efficient? And we talked a little bit about that. A new, fancier engine, better equity, would make it run more efficiently, as well as some of the features, as well as the outside, the exterior of the vehicle, making it more aerodynamic and things like that would save you gas in the long run. What things could a new truck be doing with its balance sheet and profit and loss to have a better efficiency than Bob? Well, obviously we want to accelerate, but we want to only accelerate at an efficient rate. We don't want to accelerate super fast, because then we use up all our cash and it leaves us broke. We don't want to brake quite as much. We want to brake as little as possible so that we're not using as much cash, right? But then also we talked a little bit about some of the features and the exterior that can help to improve the efficiency of the company, how much cash is being used. Okay. So, just as a quick review, we have the balance sheet, we have the assets, what you own, the liabilities are what you owe, and we have the equity. And the assets are like the external of the vehicle, the liabilities are like the features of the vehicle, and the equity is like the engine of the vehicle. Okay. Then we have the equation income minus expenses equals profit. And the income is the revenue of the company. We compared that to acceleration. The expenses are the braking of the company, how much we're braking that on that vehicle, and that is the different expenses of the company. We had the cost of goods sold for the company, which we compared to the RPMs and how high that the RPMs are running and how much, what percent of our sales is our cost of goods sold. And the last thing was the statement of cash flows. It's like the gas of the vehicle, and it's like the gas gauge on the car. It tells us how much cash we have, just like the gas gauge on a car tells us how much gas we have, and how often we have to refill, and how efficiently we're using that cash. Okay? So again, I'm Jeremy with Foundation Accounting and Consulting. It's been great to meet here with you today. I hope that you've been able to take something great away from this. Please let people know about our series here and that we have the CE credits coming up. And if you have any other questions, I'm more than happy to help you out. So again, it's Foundation Accounting and Consulting. There's my name, Jeremy Lott. Phone number is 801-440-4540. And that's 801-440-4540. My email address is jeremy@foundationacs. The ACS stands for Accounting Consulting Services. So jeremy@foundationacs.com, and my website is just foundationacs.com. So thank you very much.